Today we're going to talk Wall Street banks and a little bit of trouble in the Magic Kingdom. But let's start with the Fed chief. Ben Bernanke went to Congress today. He's still there now because it's Congress, and when you're testifying in front of the Joint Economic Committee, it's going to be a long day for you. But the headline, guys, is that Bernanke said the U.S. job market is still weak and that it's too soon for the Fed to end the stimulus program. So, Matt Koppenheffer, I'll just start with you. Any rumors or any thinking that the free money forever program was going to end and that Bernanke was going to telegraph that's off the table now?
I think so. And, I'll be perfectly clear on this. I think this is kind of an unpopular thing to say, but I think he's right. I think that's the bottom line. You look at the indicators. The economy is starting to improve. We've seen some GDP growth. We've seen some employment growth, but it's not growing very fast. We're not seeing much in terms of price inflation. We're not seeing stretching capacity. So, Bernanke is basically fighting against Congress. If you're cooking in the kitchen and you're trying to make something delicious and somebody is coming in and putting dirt in your soup, that's sort of like what Congress is doing to Bernanke.
That's bad.
It is bad. It doesn't make for a tasty stew. But I think that he's got little choice except to keep accommodation in place for now.
You agree with this?
Well, yes, except I worry that he's fighting something bigger. I mean, I know one of the mandates of the Fed is, unemployment. The problem is I feel like we're down at 7.5% unemployment right now. And I just feel like we might be at a point where there's a structural problem with the U.S. economy. And that is we don't have enough jobs for the low-skilled workers, enough jobs for those low-skilled workers that's actually going to really dramatically bring down the rate. I mean, and that's why, there's all this pressure to pass this new immigration bill. You got executives from Silicon Valley saying, hey, we're hiring. We're hiring thousands of people. We just can't find enough. And we can't find enough programmers. We can't find enough systems analysts, network specialists. So I'm worried that the Fed's on this, train, this ever faster moving train, trying to get to this some mythical 6%, I guess, unemployment rate, which is their target. They might not ever get there. And then at that point, what's the end game if that is the conclusion? That's kind of what I'm worried about.
Yeah, that does seem the 6%, while great in theory, I just look at that and think, boy, is that
really full employment today in the new normal? I hate using that phrase.
Is that really full employment, or is that sort of a stretch target? And if we actually get it down sustainably under 7% and it's 6.8, 6.7, that sort of thing, then the conversation can be had about moving it, saying, we're close enough. I don't know, but Matt, we were talking earlier this morning. If you're a Wall Street bank, this is music to your ears, isn't it? The free money forever.
It at least puts the pain off for a little bit longer. This won't continue forever, and when it does change, it'll eventually be better news for banks. Not necessarily just the Wall Street banks. I mean, banks across the U.S. Because essentially right now, when they're trying to lend money out, they're getting very little return for it. When the policy changes, when rates start rising, the quicker to change funding costs that these banks face will rise faster than the assets that they're holding, and that'll be bad news for their bottom line. As we look out longer term, though, they'll be able to lend at higher rates. Eventually, we'll see the interest spreads start to expand again for the banks. But in the short term, it'll be bad news for them. So right now, with Bernanke saying keeping money cheap, it'll be good for the banks, at least for the next couple of years.
We had talked recently about the market hitting a new high. It's seemingly every other week, and to the extent that something like that on a large scale affects your investment approach. Does this affect your investment approach? Monetary policy in the U.S., does it matter to you? Is it at all a factor, or is it just something that is sort of on the back burner for you as an investor, and instead you look at it as, if there's some radical shift, then maybe it's going to change my investing approach, but otherwise, no, I don't take this into account.
Well, for me, it doesn't. I mean, I'm looking at the Fed. I want to understand what's going on there. I want to understand the impacts that it has. But even in terms of banks, which are going to be some of the most affected institutions from the Fed's policy, I'm looking at who's running the bank. I'm looking at the value of the franchise, how they're operating, and trying to guess what Bernanke is going to do, whether I think he's right or not, is not a winner's game.
I am paying attention because even Buffett himself said it will be the shot heard around the world when the Fed sort of steps back off the gas pedal. And so just my only perspective is when that happens, I think there's likely going to be a market correction. Your banks will probably sell off especially, and so there are going to be opportunities. And so you just want to be ready to take advantage.
Is this a situation where companies that have more cash on the balance sheet are going to be in much better shape than companies that don't?
Well, companies that have more cash on the balance sheet are always better off.
Yeah, I was going to say. As soon as I said that, I thought, well, you know what? All things being equal, you probably want to be a company with a lot of cash on the balance sheet.
But I think especially looking at financials, looking at banks or insurance companies, for example, which are better capitalized, they're going to be able to take advantage of higher rates, as Matt was talking about in the long term, and that's a good thing. So look for those well capitalized banks, and those might be ones you'd look at as opportunities.